Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for 𝗧𝗴𝗀𝗲. Today is Monday. It is August the 30th. Finally, officially, we're at the end of August. As you can see here, there's not really much going on pre-open today on a Monday, which is probably a good thing. You don't want too much volatility coming into Monday morning. And again, as I said, we are still kind of in a holiday zone till things are going to start picking up. And I'm going to say it again. They're just going to start picking up after the holiday next week, after the Labor Day holiday. That's going to be some time. And again, as you can see here, Monday, Tuesday, we still have the end of the month tomorrow. And then Wednesday is the 1st of September. And then as we get into the weekend, I think it's going to be, let's see, Friday, so 4th, 5th. 6th is going to be a Monday, so about the 6th or 7th of September, second week of September. Let's just say that. That's when things should really start hitting off. Now, we've got a lot of data this week. We've got pending home sales, manufacturing activity. The real biggest, the theme for the week, if you will, is going to be inflationary pressure. You've got consumer confidence. You've got price indexes, you got a lot of manufacturing data coming out, you've got jobless claim, but the biggest factor is going to be manufacturing, construction spending, productivity costs, factory orders. We're going to see whether there's an inflationary or how much inflationary pressure and how much it's impacting us on the manufacturing and on the wholesale level. That's going to be very pertinent. I highly suggest you pay attention to the bond market this week. Most of the data coming out this week doesn't impact stocks directly. It impacts the bond market directly, and the bond market impacts the stock market. So most of this data, especially the construction spending, manufacturing, ADP employment number, that's a bond number. Now I'm expecting, and we'll go through global economy and all that stuff in a minute. But the reason the bonds are up is because the Fed is not going to take any action. And the reason they're not going to take any action is because of the spike in COVID. They didn't really make a big deal out of Afghanistan. And I don't think Afghanistan is going to be a big global economic, it's a big issue, but I don't think it's going to be a big economic issue. So I think the biggest driver is COVID and whether or not this Delta variant is going to progress or it's going to fade out over the next few weeks. If it's going to fade out, I think the Fed is going to slow down bond purchases by maybe end of September, October, and that would cause the bond market to come off, because what's causing the bond market to rally right now is the Fed putting money into the bond market, $120 billion a month. If they stop doing that, the bond market will sell off and start trading below the 200-day moving average. And interest rates will finally go higher. The biggest reports you want to pay attention to this week is going to be consumer confidence. Consumer confidence impacts the GDP substantially because consumers make up 2/3 of the GDP. Retail sales is 2/3 of the GDP. And consumers make up retail sales. So keep your eye on the report tomorrow. Keep your eye on the manufacturing index. Keep your eye on international trades and goods and services. It's going to be very interesting to see how the Delta variant has impacted other countries like China in terms of exports. And then again, productivity and costs, and then employment situation and jobless claims. But again, I think the biggest part of this week's report is going to be giving us clues if inflationary pressure and bottlenecks, that's right, bottlenecks, and lack of employees is impacting global economy, or if economy is still rising in light of that. And again, please keep your eye on the bond market. Now, in terms of global economy, let's talk about what the Fed talked about last week. And again, I'm kind of going through the same thing, but from a different perspective. Why? Because I want you guys to have every possible clue as to what the hell's going on with this economy. Federal Reserve signaled low interest rates will be here for a while. The gains have been getting increasingly tentative as markets begin looking towards the possible end of Fed's assistance. And I'm going to tell you, in terms of the stock market, I'll quickly go through it. I don't want to go through the same thing every day, but boy, oh boy, talk about fragmentation. Last week, Powell noted past mistakes. Remember when I said about a year ago that the Fed is putting themselves in a corner by prematurely doing things? He's admitting to it. That's right. I'm actually going to take a screenshot of this and show it to my guys in my VIP program. Listen to this. Powell noted past mistakes where policymakers made premature moves in the face of seemingly high inflation. He made clear a slowing of defense bond purchases doesn't mean a rise in short-term rates is imminent. That would require the job market and inflation hurdle to substantially more stringent test. Substantially more stringent test. Again, folks, he started taking action a lot earlier than it was needed. That's what I was saying. He's kind of putting us in a corner a lot earlier than he had to by lowering rates when the economy was still humming. But finally, he's admitted to mistakes. Regressions, folks, regressions, big part of the Fed. I got to have a good time here too, right? One problem Powell noted was the Delta variant. See, I knew it. He was going to start talking about Afghanistan or the Delta variant. The Delta variant is behind the recent surge in COVID infections in Asia, where the vaccine rollout has been slower than U.S. The Delta variant has already slowed some economic activity. In the U.S., a report on Friday showed that consumer spending rose 0.3% in July. That's sharply down from 1.1% jump the month previously. That's a big deal when consumer spending is the driving force in the economy. As I mentioned, it's about 70% of the economy. And its growth slowed even though income growth for Americans accelerated last month. That is a big red flag. Now, in terms of the stock market, Nasdaq keeps making all-time highs while the RSI can't get higher. Fragmentation on the 11 sectors remains. Look at this. Technologies here. Where's consumer discretionary? All the way down here. They are getting closer, I will admit it, and industrial and basic materials are together, but till technology and consumer discretionary are next to each other, markets are, and till we still have this fragmentation and this divergence. Look at this. Higher highs, lower highs. That is the stretched market that's trying to pull higher, and I don't play that game. Now, in terms of the sectors, 11 sectors, let me show you what's going on. Financials are looking pretty good, and there it's at a major resistance level, and I think there's a good chance they'll break out, and I like financials. I also like energy. If this XLE can get above the 51 level, 50-70 level, I think we got a good run, and I think energy will move back up. Utilities, I'm not all that happy about, especially if the market's going to go higher. Utilities, red flag. I like industrial stocks, and I think there's more upside. Not too much, but a little more upside before we pull down. Consumer staples are looking bad. I think we're going to jump on this pullback up to the 73 level. Healthcare is starting to sag a little bit. Technology is looking good, but I think there's too much volatility, and I would be very cautious with tech. Basic materials, very similar to industrial. I think if we can get past this 86, 70 level, we can go higher. I like real estate. As I've said last week, real estate was the only sector that I really liked last week. I like this choppiness. I think we're going to break out higher. The communication service looks good, but too much volatility. And consumer discretionary, big question marks. But if it gets above the 182 level, we may see some upside. So the markets are actually looking better than they looked last week, believe it or not. They're actually looking a little more bullish. Out of all of these sectors, the one that I'm really liking is industrial and basic materials and consumer staples. I like consumer staples, I like materials, and I like industrial right now. And financials not looking bad either. Energy may be a big runaway market if we pass this 50-ish level. And if you look at the crude oil, it won't look all that different. Let me just go to crude oil. Why isn't it giving me crude oil? I want my crude oil. Let's go to energy market. Let's look at crude oil. I demand my crude oil. Let's see if that looks similar to the ETF. Yeah, it does. Why don't we look at nearby? There, oops. What the hell's going on here? So as you can see right here, if it breaks the 60-ish, if we break this, if we go just a little bit higher, if we break this 71 level, we're going to go hit all-time highs again. Or not all-time highs. What am I saying? Swing highs. Swing high, not all-time highs. But look at the last 10 years. We haven't had price reach these levels on a monthly. Yeah, that 76 level is really something. We haven't seen price reach these levels in 2018, and before that, it was 2014. So I think there's a really good chance we're going to break out. If we break above this level right here, this 77 level, watch out. Watch out. And again, look at this ascending triangle. I love these ascending triangles. And this is on a monthly basis. So this is a long-term trend. Nice ascending triangle. All right. In terms of the stocks you should be looking at right now, I've got two stocks, a bullish stock and a bearish stock. Bullish stock, O'Reilly. O'Reilly Motive, people are buying cars, new, used cars like there's no tomorrow. What does this car do? Supplies, new supplies, large specialty for retail auto supplies, aftermarket supplies. And look at how good the stock is looking. On a daily basis, it's pulling back to the 50-day moving average. It made a swing high previously to that. If you look at a long term, look at the long term, the stock is moving. Look at the weekly performance, just backing off a little bit. But I think we're going to see more upside, or at least a bounce to the 616 level. We're at the 592. I think we're going to go back to the 617 level. RSI is not overdone right now. It looks good. Now, on my short list, also an automotive component stock, IAA. Here's what we got here. Now, this stock provides salvage vehicle auctions and related services. It looks like people don't want to buy used car parts right now. It looks like they want to buy new car parts. And look at this stock. Lower highs, as you can see here, the highs are getting lower, breaking below the 200-day and the 50. The 50 crosses below the 200. Completely opposite of what we would be looking for in a bullish sign. We make a new swing low, and now we're pulling back to the 50-day moving average. Now, there's a chance we'll pull back to the 55 level before coming back down, but it looks pretty bearish right here. I think we're going to come off. I mean, we're at new highs right now, right? We're literally at new highs right now. This IAA stock, it's not doing anything. So with the market making new highs and this thing swinging near close lows, it doesn't look like we're going to get much upside. So I would sell this near the 53 level, and if it rallies to the 50-day line, dump it. Or maybe if I would leave it alone, and then if it breaks above the 50-day line, then I would liquidate it. But I would give it to the 50-day line. Give it a little breathing room, and I think this will go down to the $50 level. And if it breaks the $50 level, let me show you something. If it breaks the $50 level, which is the, let's see here, September 2020 low, this thing can go all the way to the $40 level. So I think if we break 50, we're going to go to the 40. IAA, used car parts, salvaged car parts, no soup. New car parts, plenty of soup. Now, before I let you go, and I hope this was nice and educational, I've got something really important, timely, and something you must pay attention to. You've got to. Now, former Air Force pilot Chuck Hughes, he's $1 million investor, and he's getting ready to close his brand new trading discovery called Omega-1. And boy, oh boy, it's been, we can't keep it on the shelves. Let's put it that way. He's revealing it to a group of traders, a select group of traders, my personal group of traders. And guess what? My viewers, you guys are invited to join Chuck on his journey. I'm really, really excited about this. You know why? Not only will he reveal this pricing anomaly that's recently paid him 104 out of 108 trades. Folks, for those of you who are not on the level with math, that's a 96.2% win rate. But there's more. He's also putting $3.4 million on the line to help you succeed with his new innovative formula. And you don't want to miss out on this. You really do not want to miss out on this. Click on the link below and learn how traders just like you, can unlock Chuck's Omega-1's trading strategy for yourselves. Remember, 104 winning trades out of 108, 96.2% win rate. Chuck's putting $3.4 million of his own money on the line. And folks, this is it. We're going to be closing it out. This is it. You do not, I repeat, you do not want to miss your opportunity to check out Omega-1. Follow the link below and learn how traders like you, just like you, can unlock Chuck's Omega-1 trading strategy. Now, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Look, if you want videos like this, you've got to stay one step ahead of the market by being notified when I post my next video giving you guys hot stocks, market analysis, global economy, the calendar, whether the S&P's overbought or not. Don't you want to know these things? Inquiring minds want to know. Follow the link below, check out Omega-1, and I'll talk to you guys tomorrow. Have a great day. Bye, everyone. Have a great week ahead, actually.